Hello, today is Wednesday, January 26th, and thank you for joining me for another edition of the Market Commentator Podcast. My name is Andy Willms, and I am the president and CEO of the Milwaukee Company. Joining me this morning is Mike Willms, who is the Director of Trading and Market Research for the Milwaukee Company. Welcome back to the podcast, Mike.
Thanks, Andy. It's great to be back.
Today, Mike and I will be discussing inflation, reflation, and what they could mean for the markets in the upcoming year. But before we get started, please let me remind you that this podcast is for informational purposes only, and listeners should conduct their own independent research before acting on any of the information or opinions expressed during the podcast, and that the views expressed in today's podcast are Mike and my personal views and not those of the Milwaukee Company necessarily. So, Mike, again, thank you for being here. And I guess the topic today, inflation and reflation, brings me right to my first question, which is what is meant by reflation?
Well, and it's a recharacterization of inflation, but it's a good version of inflation versus the negative inflation that we all fear. And reflation is a fiscal or monetary policy designed to essentially expand output, stimulate spending, or curb the effects of deflation, which, I mean, deflation is usually caused by a recession or an economic slump. So it's a policy response at either the federal government level or the Federal Reserve to try and restore the long-term trend in the inflation rate.
Reflation is sometimes thought of as policies that are intended to negate or at least mitigate the contraction phase of the business cycle. Although almost every government tries in some form or another to avoid the collapse of an economy after a recent boom, I don't think there's ever been an instance where any government has succeeded at completely avoiding the contraction phase altogether. The reflation policies, I guess, could be described as policies that are designed to at least mitigate the contraction phase, given that it can't really be eliminated altogether.
I would agree with that 100%. You wouldn't have an economic cycle unless you had the economic contraction and the trough, so to speak.
Right. So I think we need to be a little more realistic about what they expect reflationary policies to do. There's been a lot of talk, don't you think, in certain political circles that contraction phase can be eliminated altogether. And myself personally, modern monetary theory sometimes argues that there's no need for the contraction phase, but I don't believe that. I do agree with you that the business cycle is not going away anytime soon.
Well, and I think we kind of need to leave it there. The whole modern monetary theory argument is a discussion in and of itself.
Yeah, you're right.
Right. But the long and the short of it, I mean, the big concern around inflation right now is the increase in the money supply. Mm-hmm. And modern monetary theory operates under the premise that there are no limits to the number of dollars that the federal government can create out of thin air. And I have a theoretical, philosophical difference of opinion around that. I would characterize that as foolishness.
Well, I think we're of like mind in that regard. So just to kind of summarize this first point, I guess one could say that inflation refers to price increases at a rate that exceeds their long-term trend, while reflation is a rise in prices that brings price increases back into alignment with their long-term trend after a period when prices have been rising at a rate that's below the trend line.
Markets would struggle with a rise in prices and interest rates responding to those rise in prices without economic growth. And if you scroll back to the 70s and the dreaded stagflation period, that's what we're hoping both the folks in Washington and the Federal Reserve are able to avoid.
Exactly. And if we had prices on average increasing at let's say a 3% rate, Mike, and we assume that for the last few years, which is what we've had, inflation at a much lower rate, let's say for the sake of our example, 1% for the last several years, then reflation would be trying to push the inflation rate back to its 3% trend line. And we've heard something from the Fed on that regard, haven't we?
Exactly. The Federal Reserve had been looking at current CPI numbers in the 1.2, 1.3, 1.4% annual increases over the last couple of months. That's a continuation from the last couple of years. Their target is for a 2% inflation rate. And one of the policy changes at the FMOC was to allow inflation to break through their target of 2%. And if it got to 2.5% or 3%, on average over some time period, we'd be at that 2% rate, and they would stand pat without raising interest rates if inflation broke through the 2% level, where previously they would have been raising rates as the inflation rate started to approach 2%.
I got it. So what are some of the policies, both monetary policies by the Fed and fiscal policies by the Congress? What are some of the policies that you think could bring about reflation and stimulate demands for goods and whatnot?
Well, I mean, the market responded, pretty meaningfully in both directions, up and down, depending on how the stimulus conversation went during the lame duck period here going into Christmas. When there was going to be an additional $900 billion in stimulus, the market went up. And when there was questions about whether stimulus would actually materialize, it went down. So the pandemic stimulus programs that the federal government has implemented are a great example. Obama, going back 2009, passed an $800 billion stimulus package around the economic trough with the financial crisis. So it's fiscal spending at the federal level, normally deficit spending, to make up for the drop in consumer demand with funding from the federal government. On the Federal Reserve side of things, it's all around monetary policy, interest rates, and now QE.
And on the fiscal side, one of the things that has been bandied about, which I personally would think would be helpful, would be large investment projects that create jobs, infrastructure and things like that.
Exactly. I mean, if you scroll back in history just a little bit, the most successful government spending program in history was the interstate highway system under Eisenhower. Mm-hmm. And the material impact that transportation improvement had on overall economic productivity, it was pretty amazing.
Well, and even if you go back to Roosevelt, right? I mean, he didn't. We've gotten to the practice of sending people checks. I don't think Roosevelt sent anybody a check, but what he did do is give people jobs working on these government projects. And, that was a win-win proposition for our country, right? It was very reflationary. It was strong. It was good for the economy. It put the money where it was needed. So it was given, the right people got the money, and the government got a return on its investment in terms of what it paid people by getting wonderful projects completed, like the Hoover Dam and others, that would never have been done but for the fact that Roosevelt initiated these programs.
Exactly, and that's very near and dear to my heart. And living up here in Lac du Flambeau, Charlie went to the Boy Scouts at a CCC built camp, and there's a number of CCC projects that still exist here in the park system, going back to Roosevelt days.
Yeah, the conservation course. I forget what the first C was for. Something conservation corps, but I can't remember my history teacher would be disappointed.
When you roll up to Camp Tasomas, it just says built by the CCC. So I'm not sure what the three C's stand for either. So
Yeah.
versus
Well,
the dreaded triple hooks for poorly rated corporate debt.
so Mike, we've talked about different types of reflationary policies and the fact that reflation isn't necessarily a bad thing and is actually a good thing if managed and implemented properly. What's your take on how inflation would impact stock and bond markets?
Well, if it's reflation and you've got a level of inflation that the Federal Reserve is targeting and interest rates are moving up, that would be viewed as a good thing from the standpoint of both equity, well, more from the standpoint of the equity markets. Obviously, if rates are moving up, that's not necessarily, well, it necessarily won't help bond prices, but we get out of the financial regression situation where it's hard to earn a representative return on any of your fixed income investments. So if you think about the most impactful policy right now, it's the Federal Reserve purchased $120 billion of bonds every month,
Yep.
80 billion in treasuries, 40 in mortgage-backed securities. And that's additional funding coming into the market that's looking for a home and a place to be invested.
So the reflation trade then would be either to sell bonds or shorten duration and to buy equities. Is that kind of it in a nutshell, would you say?
Well, I mean, that's pretty much what the market has been doing going back to September. You've seen the 10-year move from 68 basis points on September 30th to 92 basis points by the end of 2020. And, it's been as high as 118 basis points already in 2021. That's an indication people are selling some of their bonds. And all you have to do is look at equity market performance, and clearly there are fund flows still into the equity markets.
Agreed. And if we think about the reflationary reflation trade or reflation itself being a sign of a strengthening economy, then you would expect that value stocks, cyclical stocks, and small cap stocks would be the sectors in the equity market that might stand to benefit from reflationary policies.
Exactly. I mean, reflation is going to involve an increase in interest rates. The biggest component of the value stocks are the banks, and rising rates are good for the banks. And if reflation is truly defined by a growth in demand, the small cap stocks are going to have the biggest potential upside in their earnings.
Okay, so now we've talked about what could do well in a reflationary environment and what the trade might be to capture that. But what could disrupt a reflation trade in your mind?
Well, I mean, it's not so much disrupting a reflation trade. It would be the negative side of the coin here with inflation itself. And the canary in the coal mine there would be you've got rising prices across the economic front and without a corresponding growth in the economy.
Yeah, and I think we also have to consider the fact that consider the possibility that the government's efforts in reflation might come up short, right? I mean, markets are already pricing in the end of the pandemic, but with inflation, infection counts still hitting record highs, and you have the rollout of the vaccine in its infancy, and you have all of these variants of the virus coming. It could be a long time before life returns to normal. And if that happens, then it seems to me that some of these optimistic projections for economic growth won't materialize. And then we could have the possibility of political gridlock, which could stall additional stimulus. And I think it's not out of the question that the Fed could lose its ability, its power over to control Treasury yields and inflation rate if the money supplies gets to a point where they're limited into as what they can do. They've already, gone as far as they can go. So the inflation trade is certainly not, buying more equity, selling bonds is not necessarily without its risk as well. But let's
Exactly.
talk.
And I think that's a great point about the Fed potentially running out of ammunition. The big risk is with their continued buying of securities under the quantitative easing. $120 billion of newly created dollars every month. If you see a decline in the dollar, that is inflationary in and of itself. So there's a lot to be keeping your eye on.
There sure is. And inflation is something we still need to keep an eye on too, right? Because price increases beyond that which the Fed is targeting could be one of the consequences of all of this monetary stimulus. So it seems to me that investors also need to keep on their toes with the potential of inflation and need to be careful about that. Do you agree?
Exactly.
And what do you think might be the biggest risks to triggering inflation in 2021?
Well, we've already seen gold hit a new high. It exceeded $2,000 at the end of 2020. The commodity markets have been on fire on the reflation, return to growth, end of the pandemic expectations. I'm not sure where we end up. Trump's anti-immigration policies were forcing wage rates up in the lower unskilled segments of the economy. If we re-implement immigration, I'm not sure if that trend continues. But a combination of input costs going up, wage rates going up, that in and of itself would be inflationary. And then you've got the issue of the additional dollars in everyone's hands from the stimulus checks. And all of a sudden, you've got more dollars chasing after not enough goods, and prices move up based on demand alone.
And exactly right. We have more when money supply increases faster than GDP. That's has always been a recipe for inflation, although fans of modern monetary theory would argue that's no longer the case. But as we've already touched on, you and I aren't buying what they're selling.
I'm not a big AOC fan.
No, and I would say too that one thing I'd like to point out is that inflation isn't always bad for equities, right? I mean, the stock market has done relatively well in inflationary markets. But in this particular situation, it seems to me with valuations being so high, one of the things that's allowed valuations to get so high is the low rate environment. And that's really been an underpinning of the above average asset valuations, because there's been really nowhere else for money to go. If we see inflation rise combined with the very high valuations we now have, I think that could spell trouble for the equity markets and really be problematic for the reflation trades we just talked about.
And that's exactly right. And it's the TINA trade. There is no alternative. The returns on fixed income are minuscule, and there aren't very many instances over history where the dividend yield on the S&P 500 is higher than the return on the 10-year Treasury.
So suffice it to say, while the reflation trade has been getting a lot of attention on the news channels like Squawk Box and things like that, CNBC and Fox Business News, one needs to be careful that they don't go too far with this, because it's certainly not the time to be going 100% into stocks, given the risks that the current market presents.
I agree 100%. I mean, there's just a lot of question marks, and mitigating risk here. A little capital preservation makes a lot of sense.
Maybe the best reflation trade in an environment like this is to increase your allocation to cash. as compared to, maybe it might make some sense to take money out of bonds and perhaps in particular longer duration bonds, but instead of pouring that money into equities, one might look at cash or at alternatives to stocks, to traditional bonds, maybe utility stocks, real estate, investment trusts.
Yeah.
Those
real estate has historically been a beneficiary of inflationary environments.
Yep. Well, okay. So Mike, is there anything else you wanted to include in our discussion today before I wrap up here?
Nope. I think we pretty much touched all the bases.
Well, great. Then thank you so much for joining me, Mike. And to all of our listeners, please keep in mind that you should not act on anything you have heard in this podcast until you have discussed it with a qualified financial professional who is familiar with your personal situation and investment objectives. And with that, I'll say thanks again, Mike, and to all of you listeners, have a great day.
This podcast is for general informational purposes only and is not intended to be a solicitation, offering, or recommendation of any security, commodity, derivative, investment management service, or advisory service. Nothing in this podcast constitutes or should be understood as constituting a recommendation to enter in any securities transactions or to engage in any of the investment strategies discussed. Viewers should consult with an independent financial professional or independently research and verify information presented in this podcast before acting on it.